and welcome students. In the last video lecture, I had explained question number 13 of your textbook. Now in this video lecture, I am going to explain you question number 16. I hope you had studied the last question number 13 and practiced it in your notebook and studied it thoroughly. Now moving on to question number 16. This question number 16 is similar to illustration number 27 of your textbook. So you can simultaneously revise both the sums, one from the textbook and another from this video lecture. So let's move on. First of all, I will be reading the question from your textbook, that is on page number 212. Parshvi and Aneri are partners sharing profit and loss in the ratio of 2:1. It means there are two partners, Parshvi and Aneri, and they are sharing profit and loss in the ratio of 2:1. It means the old profit and loss sharing ratio is 2:1. Their balance sheet is given to you. Let us have a look over the balance sheet. Capital of two partners is given, capital reserve, workmen's saving account, workmen's profit sharing fund. Students, capital reserve is an accumulated profit that can be distributed amongst the old partners in their old profit sharing ratio. But workmen's saving account and workers profit sharing fund, they are not an accumulated profit. They are the liability. So they cannot be distributed amongst the old partners in their old ratio. Next, 10% loan from bank and creditors. On the asset side, the first entry, that is of goodwill. Students, already we discussed that if in the old balance sheet the goodwill is given to you, then that goodwill is earned by the old partners. So that is to be distributed amongst the old partners in their old profit sharing ratio, because it is earned before the arrival of the new partner. So it is to be distributed amongst the old partners. Next, building, furniture, stock, debtors and cash. Now moving on to the adjustment. Before that, last we have to see what we have to prepare over here. Here we have to prepare necessary accounts and balance sheet after admission. Students, in board exam also generally journal entries are not being asked to you, only to prepare the necessary accounts and balance sheet after admission. It means basically 3 accounts and 1 balance sheet that you have to prepare in this type of sums. Now let us have a glance over the adjustments. The first adjustment, that is new P&L sharing ratio, is to be kept at 3:4:2. It means in this question, new profit and loss sharing ratio is also given and old profit and loss sharing ratio is also given to you. So you have to find the sacrifice ratio, because whenever the new partner will bring the goodwill, then that goodwill is to be distributed amongst the old partners in their sacrifice ratio. So sacrifice ratio we have to find in this sum. Next one, Hensi brings rupees 40,000 as capital. So capital brought by the new partner, that is rupees 40,000. Its journal entry, that would be cash account debit to Hensi's capital account credit. Personal expense of Parshvi paid by the firm is debited to P&L account rupees 5,600. Personal expense of Parshvi, that were actually the personal expense of Parshvi, but they are debited to P&L account. So in future the firm will receive that amount from Parshvi. So Parshvi's capital account, that will be debited, and revaluation account, that will be credited, because that much amount will be deducted from his capital account and revaluation account will be credited, because profit will be earned or that amount will be received from that particular partner. Next one, reconstruction expense is paid by Aneri. So reconstruction expense, it is one kind of expense, loss for the firm, so revaluation account will be debited and concerned partner's capital account will be credited. Goodwill is valued at rupees 90,000. Now total goodwill is given to you, that is rupees 90,000. Out of that, new partners share that we have to find out. Then afterwards, Parshvi and Aneri will maintain their capital in the new firm in the new profit and loss sharing ratio by taking Hensi's capital as base. It means in the new balance sheet, Parshvi and Aneri will maintain their capital in the new profit and loss sharing ratio. Now what is given the new profit and loss sharing ratio? That is 3:4:2. Out of that, the new profit and loss sharing ratio of Parshvi and Aneri, that would be 3:4. So the new share of the capital, that would be distributed in the ratio of 3:4. It means 3/7 and 4/7. And by taking Hensi's capital as base, because Hensi's capital in the new balance sheet, that is already specified to you, that is rupees 40,000. For this purpose, necessary adjustments to maintain that closing capital. Over here, the closing capital is given to you. To maintain that closing capital, whatever the difference arises in the partner's capital account, the adjustment has to be made in partner's current account. It means whatever the difference comes, we have to adjust in the partner's current account. Is it clear? So basic orally I have explained the sum. Now practically we'll be doing the sum by looking at the question. The first one entry that we have to do, I had already told, that is after preparing the account you have to mention the opening balances. Over here, first of all, in the partner's capital account I have written by balance brought down. You can see from the old balance sheet that is for Parshvi 91,000 and for Anili that is 84,000. Then afterwards we have to look at the first adjustment, goodwill. Old goodwill is to be distributed amongst the old partners. You can see asset sides, the first value is given of goodwill, that is 21,000. So that 21,000 is to be distributed in which ratio? That is 2:1. This is old ratio, right? So 21,000 is to be distributed amongst the two partners in the old ratio, that is 2:1. So you can see on the debit side of partners capital account, the entry what it would come, that is Parshvi's capital account debit, Aneri's capital account debit to goodwill account credit. So you can see on the debit side of partners capital account I have written to goodwill account 14,000 and 7,000 in the ratio of 2:1. It would come to 14,000 and 7,000. Now after that you can see that Hensi brings rupees 40,000 as capital. Whenever the new partner is bringing the capital in the firm, so the journal entry that would come, cash account debit to Hensi's capital account credit. So you can see in the partner's capital account credit side I have written by cash account, that is in Hensi's column 40,000. Okay, up till here clear. Then the third adjustment, interest on bank loan is outstanding for 1 year. Now you can see on the liability side, 10% bank loan is given to you. 10% bank loan, so 35,000, 10% you will count, then it would come to 3,500. So that interest is outstanding. Outstanding interest, so it becomes your liability, because of which your liability increases. If your liability increases, then loss will occur to the firm. So revaluation account is debited. Here you can see I have written on the debit side to outstanding interest on loan, that is rupees 3,500. And in the new balance sheet after admission I have written as a liability outstanding interest on loan, that is 3,500. Now on the liability side there is capital reserve also given 14,700. So here you can see I have distributed capital reserve in the ratio of 2:1 amongst the old partners, that is Parshvi and Aneri. Students already had clarified that capital reserve is an accumulated profit and that is to be distributed amongst the old partners in their old profit sharing ratio. But workers saving account and workmen's profit sharing fund, they are liability and they cannot be distributed amongst the old partners in their old profit sharing ratio. They have to be shown as a liability only. See, you can see in the new balance sheet after admission I have written as it is workmen's saving account and workmen's profit sharing fund, that is as it is 7,000, 8,400 I have written. I have not distributed amongst the old partners. Now in case of capital reserve, I have distributed the value of capital reserve that is given to you, that is 14,700. 14,700 you will distribute in the ratio of 2:1. That is the old ratio. So distributing it would come 9,800. In case of Parshvi and Aneri it would come to 4,900. Now last entry in the liability side, that is of creditors. Creditors, no any adjustment is given to you. So as it is creditors 39,900 that I have written in the new balance sheet after admission. Now moving on the asset side, goodwill first entry that we had already distributed amongst the old partners in their old ratio. Now building, there is no any adjustment, so as it is building value I have written over here in the new balance sheet, that is 1,40,000. In case of furniture also no any adjustment, so as it is 28,000. Stock also there is no any adjustment, so as it is 18,200. While posting the entry from the old balance sheet, you have to verify if there is any adjustment related to it, then necessary effect you have to give, and then afterwards the new value of assets and liabilities that you have to write in the new balance sheet. But over here there is no any adjustment related to that assets or liabilities, so we are just posting as it is from the old balance sheet. So building, furniture, stock as it is. Now debtors value, that is 16,800, there also no any adjustment is there, so as it is in the new balance sheet. After that cash. cash balance is given to in the old balance sheet, that is 56,000. Now new partner, I have not prepared over here cash account. In the last sum I had prepared cash account because there were few entries related to it. If you prepare also, then also no any issues, but here there is only one entry related to it, so just I have added over here instead of preparing separate cash account. So here you can see 56,000 that I have written in inner column, plus whatever the capital the new partner Hensi is bringing. What we had discussed the entry, again we are revising. Cash account debit to Hensi's capital account credit. How much capital he is bringing? He is bringing rupees 40,000. So that much cash comes in. So that's why I have added that much X capital that I have added, that is 40,000. So total new cash balance that would come to 96,000. Okay, now current account and balance that has been written on both the sides, that is asset side and liability side, that is a very important point that I will be explaining. First of all, let us move on to the adjustments. Now after completion of the balance sheet, we are moving on to the adjustments. First one, that is the new profit sharing ratio. Second one we had already discussed, that is he is bringing 40,000 as his capital. Third one also we had completed, that is interest on bank loan, that we had already written over here. See, it was an expense or loss for the firm, so on the revaluation account debit side, and being a liability I have written on the liability side of the balance sheet. Now moving on to the fourth one, that is personal expense of Parshvi paid by the firm is debited to P&L account rupees 5,600. Personal expense of Parshvi, actually it was the personal expense of Parshvi, but it is paid by the firm and debited to P&L account. So in future that much amount is to be received from Parshvi and it will be profit for the firm. So here you can see on the credit side I have written by P's capital account credit, that is 5,600, and P's capital account I have written debit side, that is 5,600 to revaluation account, that is 5,600, because that much amount will be received from Parshvi in future. So it will be profit for the firm. That's why it is recorded on the credit side of revaluation account. Now fifth adjustment, reconstruction expense is paid by Aneri rupees 8,400. Reconstruction expense is not paid from the firm's capital, but it is paid from by individual, one of the partner. So entry what it would be, that is reconstruction is one kind of expense. Because of expense the loss will occur to the firm, so revaluation account will be debited. We'll write the entry, that is revaluation account debit to Aneri's capital account credit, because she is the giver. Aneri is giving that much amount from her capital, so Aneri's capital account will be credited. So here you can see revaluation account debit side I have written to A's capital account credit 8,400, and over here in Aneri's capital account credit side I have written by revaluation account, that is 8,400. Now the sixth and seventh adjustments are very important. That is, sixth adjustments, goodwill is valued at rupees 90,000. Now total goodwill is given to you, that is 90,000. Out of 90,000, the share of goodwill, see first of all I have written over here total goodwill, that is 90,000. Second working note that you can see over here, that is total goodwill, that is 90,000. Out of that, share of the new partner Hensi. Now what is the new ratio that is given to you? 3:4:2. So new share of the new partner, that would be 2/9. So his share in goodwill, that would be 90,000 into 2/9. So it would come to 20,000. That is the share of the new partner, that is Hensi. So Hensi's share in goodwill, that is rupees 20,000. Now you are very well knowing that goodwill, whatever the new partner is bringing, is to be distributed amongst the old partners in their sacrifice ratio. So first of all we have to find the sacrifice ratio over here. So I found the sacrifice ratio. You can see sacrifice ratio is equal to old share minus new share. So P and A, they are the old partners, so we have to find the sacrifice of P and A. P means Parshvi and A means Aneri. So Parshvi's sacrifice ratio, old share, that is 2/3, because 2:1. So 2/3 minus new share 3/9. By taking the LCM, the value would come to 3/9, positive 3/9. In case of Aneri, you can see old ratio, that is 1/3, new ratio, that is 4/9. So 1/3 minus 4/9 is equal to minus 1/9. We had already discussed in reconstruction chapter also that if by sacrifice ratio the answer comes negative, then it is gained by that particular partner. So here you can see by sacrifice ratio the answer is coming negative. If the answer comes negative, then that is the gain. So we have to find the share of goodwill of A also, because now Aneri and Hensi, both the partners will have to give the goodwill to only one partner, that is partially. So now to find Aneri's share, I have written the total goodwill we are knowing, that is 90,000. So 90,000 multiplied by share of Aneri. Share of Aneri, what it is? 1 by 9. So 90,000 into 1 by 9, it would come to 10,000. So partially will get the share from Aneri, that is 10,000, and from Hensi, that is rupees 20,000. So the receiver is only one, that is partially. So the journal entries they have written over here, journal entry of goodwill you can see on the board, that is A's capital account debit, because these both are giver, and P, that is partially, is the receiver of the goodwill, because he is also gaining, that is Aneri is also gaining. That's why both the partners will be giving their share of goodwill to partially. Okay, so the journal entry, that is A's capital account debit 10,000, X's capital account that we have already found out, that is goodwill of Hensi, that is 20,000, and goodwill of Aneri, that is rupees 10,000. So A's capital account debit 10,000, X's capital account debit 20,000 to P's capital account credit, that is rupees 30,000. So now we have to do the posting of this journal entry in the capital account. Here you can see A's capital account debit, X's capital account debit. So in both the entries you will write debit side, you will be writing 2P's capital account, 2P's capital account, and in the column of in the column of A you will write 10,000, and in the column of H you will be writing 20,000. Simultaneous entry in P's capital account credit, P's capital account credit, so you will be writing opposite name, that is A and H. So by A's capital account, that is 10,000, and by H's capital account, that is 20,000. So you have to do just the posting of this journal entry. We have already learned in standard 11th how to do the posting of combined journal entry. So this is the example of combined journal entry. Now, after understanding the point of goodwill, that the partner that is gaining, that whatever he is gaining, he will be giving to the another existing partner. So here the amount of goodwill that he is gaining, he will be giving to the remaining partner, that is partially. So share of goodwill of two partners will be gained by only one partner, that is partially. So this journal entry will be to do the posting. Now moving on to the last and important point of this sum, that is 7th point. Partially and Aneri will maintain their capital in the new firm in the new profit and loss sharing ratio by taking Hensi's capital as base. It means in the new balance sheet, the ratio of the capital of Partially and Aneri will be maintained in the new profit and loss sharing ratio by taking Hensi's capital as base. See, I have shown the working note over here. Hensi's capital as base. What is the share of Hensi, new partner, that is 2 by 9. And what is the share of capital that he is bringing, that is 40,000. So we have to first of all find the total goodwill by this calculation. For 2 by 9, his share of capital is 40,000. Then for one full capital, what would be the share of capital? So here you can see I have shown the calculation, 40,000 into 9 by 2. It would come to 1,80,000. Now this 1,80,000 is the total capital. Is the total capital of all the three partners. Out of that, I will remove the share of, from 1,80,000, I will remove the share of the new partner. That is clear, that is 40,000. So hence his share that I have removed. Remaining capital is 1,40,000. Now that is to be distributed amongst the amongst the old partners in the new profit and loss sharing ratio. Now what is the new profit and loss sharing ratio? The total of 3 is given, 3:4 is to 2. But the new profit and loss sharing ratio of only these two partners, that is that is Partially and Aneri, that would be 3:4. So the total capital after subtracting the capital of new partner, that came to 1,40,000. 1,40,000 is to be distributed in which ratio? 3:4. Not 3:4:2, because after subtracting the share of the new partner, remaining capital is to be distributed in the new ratio. That's why after subtracting the share of the new partner, the new profit and loss sharing ratio of the old partners, that is 3:4. So 3 by 7 and 4 by 7, it would come to 60,000 and 80,000. So Partially's share, that would come to 60,000, and Aneri's share, that would come to 80,000. So now here the important point comes, we have to maintain the closing balance. Previously in the last sum, we had found the closing balance. Over here the closing balance is already decided to you. So to maintain this closing balance, whatever the difference would come, that adjustment we have to maintain in the current account. Whatever the difference comes in each and every capital account, that difference we have to adjust in the partner's current account. Okay, so your partner's current account will be coming and that balance will be showing in the new balance sheet after admission. So over here, first of all, I have written the capital that we have found out, that I have written as closing balance over here. Two balance carried down, that is of Parshvi that we have found out 60,000, of Aneri that is 80,000, and of Hensi that is as it is rupees 40,000. So to maintain this capital, whatever the difference comes, that we have to adjust in the partner's current account. Again, I am revising that last adjustment. Parshvi and Aneri will maintain their capital in the new firm in the new profit and loss sharing ratio. What would be their new profit sharing ratio? That is 3:4. It means 3/7 and 4/7. By taking Hensi's capital as base, over here you can see I have taken the Hensi's capital as base, 2/9 share. So his capital is 40,000. So one share, then how much? So total capital that came to 1,80,000. That I have distributed in the ratio of 3:4. For this purpose, necessary adjustment should be made in partner's current account. It means after maintaining this closing balance, if there any difference comes, then that difference is to be adjusted in the partner's current account. Now, up till here, I hope so everybody is clear. Any adjustments? Let us look. Any of the adjustment is remaining? No. Okay. And any of the entry from the balance sheet, old balance sheet, is also not remaining to be posted in the new balance sheet. Now moving on, first of all we'll close the revaluation account. So look in the revaluation account. Here you can see debit side total will be more because there are two entries on the debit side and there is only one entry on the credit side. So debit side total, it would come to 11,900. Both the side you will put. Difference that comes to 6,900. Sorry, 6,300. If the difference comes on the credit side, then it will become loss for the firm. So loss will be distributed amongst the old partners in their old profit sharing ratio, that is 2:1. So P, it would come 4,200, and for A that would come to 2,100. So here you can see simultaneous posting I have done in partners capital account also. To revaluation account it is written 4,200 in Parshvi, and in Aneri that is 2,100. Okay, after closing the revaluation account, let us close the partners capital account. In partners capital account, you can see that in case of Hensi, we had written one entry that is 20,000. So here total comes 60,000. If total comes here 60,000, then here the difference comes of rupees 20,000. That we have to adjust where we had already discussed in the last adjustment, that if any of the difference comes in partners capital account after maintaining the closing balance, that is to be adjusted in the partners current account. So your difference that comes of 20,000, because total of both the side comes 60,000. So difference 20,000, here it would come by partners current account, that is 20,000. Okay, in the same way we have to see for Parshvi and for Aneri. For Parshvi, you can see that the total of credit side is more. So credit side total that comes to 1,30,800. Both the side you are writing 1,30,800. Difference that comes to 47,000. So on the debit side, two partners current account that I have written here 47,000. Now you can see partners current account I have written over here 47,000. It means it is a credit balance, because when the total of credit side is more and difference comes on debit side, then it is always a credit balance. It means liability. So here you can see credit balance of current account I have written on liability side, that is 47,000. And over here in case of Aneri and Hensi, the total of debit side is more compared to credit side. So the difference comes on credit side. So debit balance is there of Aneri and Hensi. So debit balance of current account of Aneri and Hensi that I have written on asset side, that is 1,800 and rupees 20,000. Now let us look for Aneri. In case of Aneri also, you can see that the total of debit side is more. So 99,100 total comes that we written on both the side, and difference that comes, that is 1,800 that we have written to partners current account. So on the asset side, debit balance of partners current account, that is Aneri and Hensi, that we have written, that is 1,800 and 20,000. And on the liability side, we have written credit balance of Parshvi's current account, that is rupees 47,000. So I hope you have cleared the partners capital account, understood mainly these two adjustment, two new topics that is of the goodwill, and the second topic that was to find the share of the new partner, that is to find the share of the old partners by taking the base of the new partner, and to maintain their closing balance. To maintain their closing balance, whatever the difference comes, that is to be adjusted in the partner's current account. So last two topics of goodwill and to maintain the closing balance, these two adjustments are very important in this sum. So revise this working note, especially I have done for you, so that the sum becomes clear to you. Okay, then afterwards, looking at the balance sheet, now we have written capital that we have to maintain, that is we have found out of P, that is 60,000, A that is 80,000, and hence that is rupees 40,000. Total that is 1,80,000, that we have already found out. Total capital that is 1,80,000 by taking base of Hensi's capital. Now after that, we already discussed these both are liabilities, so as it is we have written. Loan also is one kind of liability to be paid, that is as it is on liability side. Outstanding interest on loan, one effect, that was a revaluation account debit side, and being a liability, it is to be recorded on the liability side of balance sheet. Creditors as it is 39,900, and current account already it is now discussed, that is the credit balance of Parshvi, that is 47,000. Now on the asset side, you can see first entry, that is building as it is, furniture as it is, stock, debtors, no any adjustment or revaluation of that assets has been given you in the adjustment. So as it is posting from the old balance sheet. In case of cash, already I had explained that I had not prepared cash account separately because there was only one entry related to the new partner is bringing the capital in the form of cash. So directly that I have added over here instead of preparing separate cash account. So 56,000 plus 40,000 came to 96,000, and current account of A and H, that is the debit balance of Aneri and Hensi, that came to 1800 and 20,000. After making all the entries posting in the balance sheet and closing the revaluation account and partners capital account, we have to do the total of liability side and balance sheet, liability side and asset side. If the total of both the liability and asset sides comes equal, it means your answer is correct. So here you can see the total of both the sides, that comes to 3,20,800, 3,20,800. So our answer is correct. So students, I hope you have understood this sum. Do practice again and again from the sum by revising from the video lecture. In the next video lecture, still we'll be doing few of the sums related to this type. Till then, goodbye. Keep practicing. Stay blessed.